Hey guys, hope you're doing well out there. Q3 earnings season is in full swing, and like always, we kick things off by looking at shares of none other than JP Chase and company ticker symbol JPM, as they are the first of the major banks, really the first of all companies to report and kick off earnings season. We'll take a look at the high level numbers, the revenues, the earnings, the profits, the book value per share continuing to increase at JP. We'll also take a look at some comments made by the CFO and CEO Jamie Dimon. Those are always important, as this man has a nearly 30,000 feet outlook on the US economy, even on largely the global economy. And as we get into the technicals, you'll see shares of JP have made a beautiful channel upwards over the last 14 years. We're coming up near the top end of the range, so we'll highlight some levels maybe where you can look to take some profits, and then subsequently where you can maybe look to step in and buy shares. As always, if you're new to the channel and find this type of content valuable, be sure to hit that like and subscribe button below. It would be much appreciated. Shares of JP Chase up just a casual 52% over the past 1 year, up nearly 31% over the past year to date. This company trading at nearly a 13 times earnings multiple, while compared to high-flying tech names looks relatively cheap compared to itself historically, also compared to other banks. Yeah, the 13 times earnings multiple, certainly not as cheap as you've seen JP in the past, but again, not overly egregious from a valuation as well. You also get a nearly 2.25% yield on this one. That continues to increase as this company continues to spit out profits. Now, over the past 1 year, this is a company that, similar to a lot of its bank peers, have performed really, really well, up nearly 50%, nearly 52% up over the past 1 year. But when you stretch it out to a little bit longer of a time frame, nearly a 5-year frame, yeah, you see why JP is the king of Wall Street and why they are the bank to own out of really all the banks, despite being slightly more expensive than all the other ones, because you get the outperformance that you seek while investing in individual companies. Even over the last 10 years, JP significantly outperforming Bank of America, Wells Fargo, and especially Citigroup. So you're paying up for the stock, but you're also getting a fantastic bank that really knows how to run themselves. Now, revenue came in at $42.65 billion in this Q3. That was up nearly 7% year over year, beating Wall Street estimates handily by nearly $1.27 billion. Guys, this looks like an NVIDIA-like beat, nearly a $1.25 billion beat. That is no small feat over at JP. And then GAAP EPS coming in at $4.37, also beating estimates by a cool 39 cents. So that's why you see shares rocketing higher, nearly 4.5% on the back of their Q3 print, because fantastic top line beat, also a nice bottom line beat as well. Now, you're also seeing book value per share up nearly 15%, also tangible book value per share up nearly 18%. These are the metrics that you want to see go up for a bank. This is really telling you that if they were to liquidate all of their assets, what sort of price per share you would be paying. Now, the reason your tangible book value isn't the same as your stock price is, first of all, this only considers tangible assets, so it doesn't consider any intangible assets that JP wouldn't be able to liquidate. The other thing you have when you buy a stock is some brand equity. Yeah, JP is a fantastic name to basically say and to have, and so you have a little bit of brand equity that you also pay for. That's not, again, a tangible thing, but you like to see these metrics going up, because that means the value of the assets that JP holds themselves also continues to increase, which again is a good thing for you, the investor. Now, the other thing that they did is they put aside some money for credit losses, standard on Wall Street, standard for really all banks, as you have people defaulting on home, auto, credit card loans all the time. And so net provisions for credit losses came in at $3.1 billion, reflecting net charge-offs of roughly $2.1 billion, and then a reserve build of close to $1 billion. Now, the increase in net charge-offs were largely driven by credit card services, along with the reserve build of nearly $882 million, also primarily in card services. So they might be seeing people defaulting just a bit more on their credit cards as interest rates have stayed higher over the past year and a half. Yeah, no surprise that the consumer might be feeling the pinch, at least on large ticket items like a home, like an auto loan as well. Now, we got comments from the CFO, and along with that, the comments of CEO Jamie Dimon on the conference call, saying that the interest income for the upcoming fiscal year looks to be a bit toppy. So this was JP Q3 that they just reported, so they're slightly looking forward to fiscal 2025. And CFO Jeremy Barnum saying that the consensus for net interest income in fiscal 2025 looks to be about $87 billion. That still at the current time looks to be a bit toppy, but certainly in the ballpark. And then along with that, you had Chair and CEO Jamie Dimon saying that it's just a number. It's going to slightly be less than $87 billion probably, but not by a lot. The other thing they're anticipating is a slight decline in net interest income for the upcoming Q4. They're expecting a quarter-over-quarter decline, as in this most recent quarter, we got $23.4 billion in net interest income. They're anticipating nearly $22.9 billion in the upcoming Q4 that we're currently in. And so the CFO is saying that the largest reason for that is the yield curve. And so they do see a clear picture of sequential declines next year as well, with the trough likely coming in the middle of 2025. And so as the yield curve, as interest rates begin to lower, that will certainly hinder the net interest income that a company like JP Chase can earn, but certainly that can help consumers take out more loans and encourage them from borrowing from banks like JPM, as again, they have less interest to pay on their loans, again, encouraging more economic activity on especially those large ticket items like homes and autos. Now, we also got on the growth front that JP is adding private bankers. They're also investing in AI, among other initiatives. And then Chair and CEO Jamie Dimon saying that what other people call expenses, he calls investments. And so in other words, expenses that are meant to pay off in the long term. And their goal at JP despite being nearly a $650 billion market cap, their goal is still to gain share. I see this company at some point down the line hitting that $1 trillion market cap, believe it or not. And so likely over a long period of time, you still continue to have upside in shares of JP just because of, first of all, how good Jamie Dimon is at running this company, but also because how dominant this bank is on really all fronts, as we'll take a look. Now, looking ahead, we still expect revenue growth in the upcoming quarter, roughly 6.5%, and then still continuing to expect growth on the EPS front in the upcoming quarter. It's when we look ahead to fiscal 2025. We're expecting that yield curve to not be as favorable to these banks as the interest rates come down, and so that will certainly impact their net income moving forward into 2025. And so certainly one of the other reasons why you might look at a forward price to earnings of roughly 13 times right now, that could look to go up meaningfully if a bank like JP really all other banks as well, they're unable to really manage the declines on their EPS next year. Now, one thing that will help is buybacks that this company certainly has, and Jamie Dimon did certainly comment on that. Now, they did say we have an extraordinarily strong balance sheet evidenced by total loss absorbing capacity of nearly $544 billion, plus cash and marketable securities of $1.5 trillion, especially on their riskiest assets, loans, totaling nearly $1.3 trillion. So keep in mind, $1.5 trillion, that's not all just cold, hard cash sitting at JP Morgan. A lot of that is assets tied into customer funds, and so that they do consider as part of their balance sheet. But again, one of the strongest balance sheet on Wall Street, considering you have nearly $500 billion loss absorbing capacity. On the behalf of share repurchases, they did say that given the market levels are slightly inflated, we maintain our modest pace of buybacks, although we reserve the right to adjust this at any time. And certainly when I take a look at the shares of JP when we get to the technicals, we'll analyze this. Shares no doubt look slightly inflated. And so no surprise. In fact, it's a welcoming sign that CEO Jamie Dimon realizing that and at least pulling back on the pace of their buybacks, even just a little bit. Now, in terms of the macro, he did say that we've been closely monitoring the geopolitical situation for quite some time, and recent events show that the conditions are treacherous and getting worse. There's significant human suffering, and the outcome of these situations could have far-reaching effects both on the short and long-term economic outcomes, and more importantly, on the course of history. Additionally, while inflation is slowing in the US, the economy remains resilient. Several critical issues remain, including a large fiscal debt, which likely will just be extended by whoever the incoming president will be, the infrastructure needs, along with restructuring of trade and remilitarization of the world. And so over at JP they continue to hope the best, and the uncertainty still remains, which is why they must be prepared for any environment. So certainly comments like these show you what is going through the mind of Jamie Dimon. Certainly the geopolitical scene and the geopolitical environment continues to be challenging. That's something he acknowledged. While you still see that, you're still seeing inflation slowing in the US and the economy remaining resilient, which is maybe part of the reason why this company believes that that soft landing can be achieved at some point down the line. Now, in terms of the overall financials, we got a pretty stellar quarter, 7% revenue growth on a year-over-year basis. Quarter over quarter, we're seeing that 15% decline on that top line. In terms of the provisions for credit losses, quarter over quarter, we're seeing a slowdown in the amount of money this company is putting aside, but keep in mind, year over year, still up nearly 125% on your provisions for credit losses. Like we heard at the top, a lot of that is on the credit card side. So I think that's something you can probably expect moving into next year, that the provisions for credit losses likely will begin to be lowered, allowing this company to flush more money back into their business as they release those loan loss reserves. Now, in terms of the different segments, you have consumer and community banking staying relatively strong, down 3% year over year, but you're seeing sequentially a increase on the net revenue side. You're seeing really flat to slightly higher revenues across the board. The credit card services continues to remain relatively strong. I think one of the reasons why you continue to put more aside for your loan losses in that segment. But overall, you're seeing your net income slide just a little bit sequentially, and then year over year down substantially, down 31%, as again, interest rates have remained relatively high over the past 1 year. And so people not really taking out home loans, not really taking out auto loans as much. And then you're also seeing a deposit decrease on the banking and wealth management side. But overall, nothing to be overly concerned about. I think that sort of the business will certainly pick back up as interest rates begin to lower. On the commercial and investment banking side, staying relatively strong, 8% year over year growth on the top line. And then your provisions for credit losses coming down 18% sequentially. This is the part of the business that continues to, in my opinion, thrive as they're still increasing the investment banking fees, as those were up 31%. You're also seeing higher payments revenue as you're increasing the fee on that side, and you also have higher deposit balance. So the commercial investment banking side staying relatively strong. Last but not least, you have the corporate banking side, and relatively small part of JP Morgan's business, but year over year, you see substantial increases, up nearly 100%. Sequentially, you are seeing a large decline. My guess is that you probably recognize some sort of one-time revenue benefit in the previous quarter, and so that's the reason why you're seeing a large decline on that front. But all things considered, the results over at JP Morgan look fantastic. You're continuing to see your average deposits grow. You're also continuing to see your average loans up 1% on a firm-wide basis. You're continuing to increase your debit card and credit card sales volumes, continue to add on more customers into your ecosystem. And yeah, this company run by CEO Jamie Dimon doing a fantastic job controlling costs and maintaining the growth on the side of investments into private banking and AI. So no doubt, I have full confidence that this company will continue to chug along and continue to post stellar results. Now, speaking of stellar results, that is exactly what shares of JP Morgan have done over the past 14 years, as you have this company locked in a very, very beautiful and very predictable uptrend of higher highs and higher lows. Now, most recently, you're coming up close to the top end of your range, which you've only seen maybe 4 or 5 times over the last 14 years. So no doubt you have seen a significant rally in shares of JP Morgan, one that in my opinion will likely pull back or see at least a breather sometime in the near future. And so if you do own shares of JP Morgan, you're probably looking at this level, call it up to around $240, even up as high as $250, as that is your range to maybe look to begin taking some profits in shares of JP Morgan. Now, I'm not saying you have to come in here and sell your whole position. Let's say you own 10 shares, probably look to offload maybe 2 or 3, maybe as much as 4 shares if you really want, because look, it never hurt anyone to take a profit. And there's only a handful of times where shares of JP Morgan come up to this top end of the channel. Certainly, if you can see a reversal at this point, your first level to probably step in is near the middle of the channel, down to call it at $200 on the nose. That's probably a level where you can look to maybe step back into shares of JP Morgan. That's your basically midway point in this upwards channel. Certainly, as you get back down into the bottom end of the range, that's where you look to add shares pretty aggressively. This company, from a technical perspective, looks honestly fairly simple to understand. As you get closer to the top end of the range, you look to maybe take some profits, offload some shares. You definitely want to sell shares of JP Morgan into strength that we've been seeing over the past 1 year. And then as this company no doubt will at some point see a pullback, see a slowdown in their business, maybe as early as next year, yeah, that's when shares will certainly look to take a breather, and that's where you look to acquire shares of JP Morgan Chase. Now, certainly for a long-term investor, if you have nearly a 10, 20-year outlook on shares of JP Morgan, you can probably look to just hold this one out, continue your ride, because as we just saw, this company continues to perform extremely well. You still have a CEO that knows what he's doing and is really fantastic, honestly, at running the business over at JP Morgan. So that was my take on shares of JP Morgan. One, I would actually look to sell into the strength as the stock has been on a tear over the past year. You're also coming up near the top end of your range from a technical perspective. All things considered though, from a financial perspective, you continue to have stellar results. Outside of just locking in some profits and seeing this from a technical perspective, there's no real reason to come in and sell shares. But in my opinion, I think it's certainly good to lock in some gains in companies like a bank, like JP Morgan, time and time again. So that was my take on shares of JP Morgan Chase and Company. Let me know your thoughts on this one in the comment section below. We're just on the eve of tech earnings, and we'll be sure to cover them for you on the channel. So stay tuned, hit that like button, subscribe if you're new to the channel. As always, I'll see you guys in the next video.